Hey everyone, and welcome back. This is one of a series of videos on American politics. In this video, we're going to explore the nature, scope, and form of economic policy in the United States. There's a lot to uncover, so let's get to it. In the simplest terms, economic policy refers to the actions that governments take to influence the economy. It covers a range of areas from the orchestration of fiscal and monetary policies to the regulation of these various sectors of the economy and even labor markets. In broader terms, economic policy seeks to achieve several competing and sometimes contradictory goals simultaneously. At the most general level, economic policy seeks to ensure three overarching objectives, namely economic growth, usually measured in terms of real growth and gross domestic product, price stability, meaning keeping inflation under control, and full employment, or at a minimum, keeping employment rates low. But the problem facing policymakers is that these three broad objectives frequently operate in contradictory ways. Policies which reduce the unemployment rate tend to increase inflation, undermining price stability. And conversely, policies that reduce inflation too low increase the unemployment rate and even strangle economic growth, so balancing between these competing objectives is a constant struggle. And balancing these competing objectives normally requires policymakers employ a variety of tools, which we normally divide into a couple of distinct categories. The first is fiscal policy. In general, fiscal policy refers to the use of government tax and spending efforts to influence the country's economy. Here, the government increases or decreases taxing or spending levels to influence the level of economic activity in the country and to promote specific sectors of the economy. The second broad area is monetary policy, which refers to policies adopted by the country's monetary authority, in the case of the United States by the Federal Reserve Bank, to affect the economy at the broadest levels. For example, the central bank may increase or decrease interest rates, reserve requirements, or engage in open market operations in order to try and influence inflation and unemployment rates in the broader economy. Both fiscal and monetary policy can be classified as expansionary, neutral, or contractionary, depending upon the outcome they intend to achieve in the broader economy. In general, expansionary policies are used during contractions in the business cycle or to address a recessionary economy. Here, the policies are intended to promote sharp increases in economic activity. On the fiscal side, expansionary policies frequently involve increases in government spending, often in conjunction with cuts in tax levels. On the monetary policy side, expansionary policies often involve expanding the money supply, reducing interest rates, or engaging in open market operations to promote economic growth. By contrast, contractionary policies are used when the economy reaches growth levels that are excessive or the rate of inflation is too high. Here, policies are intended to curtail the rate of growth in the economy. On the fiscal policy side, contractionary policies frequently involve cutting government spending, often in conjunction with increases in tax levels. On the monetary policy side, contractionary policies often involve shrinking the money supply and increasing interest rates. Let's look at some of these in a bit more detail. And let's start with monetary policy. In the United States, the Federal Reserve System, often referred to simply as the Fed, is the central banking system. Established in 1913, the Fed serves several critical functions. First, the Fed is charged with overseeing and regulating U.S. banks to ensure safety and soundness of the financial system as a whole. It sets standards for banking operations and can provide emergency assistance to banks at risk of failure. When a bank is deemed insolvent or believed to create a systemic risk to the American economy, the Fed may organize a takeover by another healthy bank. Second, the Federal Reserve provides financial services to the U.S. government, U.S. financial institutions, and many foreign governmental institutions, including playing a major role in operating the nation's payment systems. In this capacity, the Federal Reserve holds millions of dollars worth of gold and other dollar-denominated deposits for foreign governments. And as we've already discussed, the Federal Reserve manages the country's money supply, overseeing the nation's monetary policy in pursuit of its twin mandate of maintaining both low unemployment and low inflation across the economy. To achieve these goals, the Federal Reserve has a number of tools at its disposal, though it relies most commonly on four. First, the Federal Reserve can use its control of the discount rate to increase or decrease the money supply. In the simplest terms, the discount rate is the interest rate at which banks can borrow money directly from the Federal Reserve, typically for very short periods. By lowering the discount rate, the Fed can encourage banks to borrow more money and thus increase the supply of money in the economy. By raising the rate, the opposite occurs, discouraging banks from borrowing and thereby reducing the supply of money. Second, the Fed can increase or decrease reserve requirements. Banks are required to hold a certain percentage of their deposits in reserve, either as cash in their vaults or as deposits with the Federal Reserve. By increasing reserve requirements, the Fed can reduce the amount of money banks have available to lend, which can reduce the money supply. By decreasing the requirement, the opposite occurs, increasing the money available to banks for lending. Third, the Fed can engage in open market operations, or OMOs, which essentially involves the buying and selling of government securities in the open market. When the Fed wants to increase the money supply, it buys government securities, taking on additional debt but increasing the money available for other economic activities. Conversely, to decrease the money supply, the Fed sells these securities. In recent years, open market operations have become increasingly common, with the Fed regularly buying and selling trillions of dollars worth of securities in an effort to manage the economy. Finally, the Fed will also often engage in forward guidance, essentially announcing its forecasts and further intentions in an effort to influence market expectations for future levels of activity or interest rates. In doing so, the Fed is sometimes able to shape behavior even without needing to take other concrete actions. Essentially, its forward guidance becomes realized because actors engage in actions which shape economic activity in alignment with the Fed's forecasts, creating self-fulfilling prophecies. Fiscal policy refers to the government's use of its revenue or taxation and expenditure or spending to influence the economy. It's essentially how the government adjusts its spending levels and tax rates to monitor and influence the nation's economy. In general, fiscal policy has similar goals as monetary policy, namely to achieve full employment, manage inflation, and encourage economic growth. Essentially, fiscal policy focuses on determining the appropriate level of taxation for individuals and businesses and deciding on the nature and scale of government spending, using these tools to stabilize the economy either by boosting economic activity in downturns or cooling it down during overheated periods. At the broadest level, government spending can be divided into two categories: mandatory and discretionary spending. Mandatory spending, sometimes also called entitlement spending, refers to spending on programs with funding levels that are automatically determined by the number of eligible recipients in those programs. Such mandatory programs are created under authorization laws, meaning Congress must provide the funding necessary to maintain those programs. Funding for mandatory programs cannot be adjusted year to year and is not subject to the normal annual budget process. Rather, any changes to funding levels can only be effected through authorization laws, that is, by changing the laws that establish the program in the first place. Examples of mandatory spending include Social Security, Medicare, Medicaid, veterans benefits, the Child Tax Credit, the Earned Income Credit, and others. In 2022, the total mandatory federal spending was about $4.1 trillion, with the largest portions of this comprising spending on healthcare and Social Security. Feel free to pause and explore this graphic in greater detail if you're interested. Discretionary spending, by contrast, is the spending that is determined and authorized by Congress each year through the annual appropriations process. Interestingly, even though most of the political battles we see between Republicans and Democrats over spending levels focus on discretionary spending, in reality, such spending is a relatively small portion of the federal budget, comprising about 27% of all federal spending, in contrast to the 73% of the federal budget characterized as mandatory spending. Discretionary spending is divided into two more or less equal parts: defense spending, which represents about 46% of discretionary federal spending, and non-defense spending, which includes spending on most other government programs, everything from transportation to education to public health to law enforcement and beyond, which altogether represents about 54% of federal discretionary spending. And again, we can see the 2022 total discretionary spending broken down here. Again, feel free to pause and explore this graphic in greater detail if you're interested. To pay for federal spending, the U.S. government imposes a variety of taxes. Income taxes are levied directly on the income of individuals or businesses. The U.S. federal income tax system is progressive, meaning that higher income individuals are expected to pay a larger proportion of their income in taxes than lower income individuals are. Tax brackets in the United States range from 0% at the bottom all the way up to 37% at the top, depending upon income. Individual states often impose state-level income taxes on top of the federal income tax. Capital gains, that is, income earned from stocks, bonds, and other investments, is taxed at a lower rate than income earned from wages, but they are still generally included in the income tax figure. Payroll taxes include specific taxes paid by both the employer and the employee to pay for a number of governmental programs, including Social Security and unemployment insurance. In total, individual income taxes generate about 52% of federal revenue, with payroll taxes comprising about a third of all federal revenue. Corporate taxes, as the name suggests, are taxes paid on profits earned by incorporated businesses. Corporate profits are generally subject to a flat tax of 21% in the United States, though some states may impose additional taxes above this level. Corporate taxes account for roughly 10% of the federal tax revenue. Sales taxes are taxes imposed on the sale of goods and services. In the United States, there's no federal sales tax. Instead, sales taxes are imposed at the state and local level and often constitute one of the primary sources of revenue for those governments. Excise duties are taxes on specific goods or services. They may be imposed to raise revenue or with the broader goal of shaping individual behavior. The federal gasoline excise tax, currently set at 18.4 cents per gallon of gasoline and 24.4 cents per gallon of diesel, is an example of the former, with the proceeds of that tax used to pay for maintenance of the interstate highway system. Taxes imposed on cigarettes or alcohol are examples of the latter, with the primary goal being to increase the cost and reduce individual consumption rather than to explicitly raise revenue. And as with the previous examples, states often impose excise duties on specific goods beyond the federal excise tax. But in total, excise duties count for only about 2% of federal tax revenue. Finally, tariffs are taxes imposed on goods imported into the country. Again, these can sometimes serve to raise revenue, and other times they can serve political objectives like punishing trading partners or protecting American industries. Tariffs generate less than 2% of federal tax revenue. But even with all this revenue, the federal government still spends far more than it generates. To finance the growing federal spending, the government has increasingly relied on borrowing, primarily by selling government treasury bills. This is nothing new. The U.S. government has regularly borrowed to finance spending. This graph shows federal debt as a percentage of gross domestic product. That is, how much money did the government owe as a percentage of the total size of the American economy. As the amount of debt the government owes increases, so too does the size of debt payments. Perhaps not surprisingly, the national debt exploded during World War II as the government sought to sell war bonds and issue other debt instruments to finance the war. But after World War II, the U.S. economy grew rapidly, reducing the debt burden. Following the 2008 global financial crisis and the 2020 COVID lockdowns, government debt once again increased dramatically, reaching and later exceeding 100% of gross domestic product. But that's it for now. Please leave any questions you have in the comments section below, and thanks for watching.